What's going on, cash flow hackers? It's Chris with Life 180, and I had a conversation this morning, and that conversation has inspired me to do this live because, listen, there's a lot going on in the world right now, and I just want to get into this. I think this is going to be a pretty quick video. I'm going to kind of go on a little bit of a rant here about the Federal Reserve, about inflation, about the government, about everything that's going on and why it's important for you to position yourself and ultimately how you can position yourself to take advantage of different things going on in the economy right now. Now, let's get into this. Let's just dive right in. Now, right now, the Federal Reserve is talking about doing rate hikes. What that means is they're talking about raising the federal funds rate from where it is now. They're talking about doing 6 25 basis point rate hikes to raise rates by 1.5% over the next 18 months. Here's the thing. We need to look at why that's not going to happen. I think it is absolutely laughable that they're talking about the fact that they're going to raise these rates and they're going to monitor the economy. Now, there's a lot of things that are happening that are going to force them to not be able to raise those rates to that level. The bond market is one of them. Bottom line is, I think raising rates even to 1.5% is going to crash the stock markets. Here's the deal, though. It's way more than that. I'm a big believer, over the last 12 years, the one thing that I've learned is not to underestimate the government's ability to manipulate the situation and kick the can down the road. The challenge is right now, they're running out of ammunition that they can use to do that. And really what they're doing is they're not kicking the can down the road, they're kicking the can up the hill to a bigger cliff. And with that said, we have to think about, okay, why are they doing this? Why are they not going to be able to raise rates? And all I think you have to do is look back in history. And if you go back to 1979, Paul Volcker raised rates by 13% virtually overnight, from 6% for the federal funds rate up to 19%. And if you understand anything about that, the 80s were a great decade because we started at all-time high interest rates and we had a declining interest rate environment. And that policy, that one move, essentially spurned a 40-year boom, right? Like we lived in this declining interest rate environment for the past 40 years. And the reality with that is what works in a declining interest rate environment from an investment strategy does not work in an increasing interest rate environment or a flat interest rate environment. And that's where we are now. And we are going to be coming back into this cycle and where we're going to have at least flat interest rates or increasing interest rates, and how you manage your money, how stocks perform, how assets perform, what you have to think about as far as what you're looking for in an ideal asset has to change to match the environment. And it's so important to understand that. Now, with that said, where we are right now, we are looking at a situation where the government is talking about raising these rates. And why do I think that the government is not going to raise these rates? People have all sorts of opinions. You can go listen to Harry Dent, you can listen to Peter Schiff, and they all have their own opinions on why this is the case. I don't want to get into all the technicals and all the balance sheet stuff that they talk about as to why they're not going to be able to raise rates. I just want to use common sense. And I think if we just look at this from a common sense perspective, we'll realize they can't raise rates because of the fact that we're $30 trillion in debt. The government can't raise rates because over 30% of their debt is in short-term debt, meaning it rolls over every single year, right? So for every percentage point that they raise the federal funds rate, that's $300 billion that are the amount that it's going to take to service that debt is going to cost the government. So imagine right now they're talking about raising rates to 1.5%. It's really, quite frankly, that number is just a pathetic number because of the fact that that's not going to do anything. We have 8.5% inflation. Interest rates need to go to 10% minimally to start to control inflation. Do you realize what it would do to this economy, to our status in the world as a government? It would crash our economy. It would lose faith we would lose our faith with the rest of the world, or the rest of the world would lose faith in our dollar as a world's reserve currency. We would lose that status as a world's reserve currency. And ultimately, it would drive up the cost to service our debt by trillions of dollars every single year. And so if that were the case, think about it. The taxes would have to go through the roof. our government would implode. I mean, ultimately it would. And so we are at this place where we're not getting out of this without some form of pain, right? That's all it comes down to. We can either do it systematically and controlled, or inflation will take care of it and will put people in financial pressure, and it'll be what it'll be. Like the market will cool down based on people's inability to spend, except for on things that they need to survive. Now, what do we want to do there? Well, I'm a big believer right now that the government is going to inflate their problems away. They're going to try to inflate their problems away. I don't think they're going to be in a situation where they can raise rates in order to accomplish successful slowing down of inflation. They just don't have the ability. They don't have enough ammunition in the chamber to be able to pull that off. And so what's going to happen is we need to be able to make sure that we have our money in places where, like hard assets, I should say, that are going to benefit from inflation, right? Things that are going to provide cash flow, things that are going to provide stability and inflation protection. Now, I think there will be a point in time that things flip and that we go into an inflationary recession or even a depression potentially. But if we go back to the 70s and 80s and we saw the last time that we actually had inflation like this, you realize that it literally was a 4, 5, 6, 7 year window that we had this inflation kind of building on us. And so I think it's really easy for people right now to get freaked out and to look at the 8.5% inflation number and to have that kind of overwhelm you and get you into these emergency mindseted decisions and kind of prepare for this doomsday kind of potential. But once again, don't underestimate the government's ability to kick the can down the road or up the hill. And so I think we're looking at a situation where we're going to have a pullback in the market. I think there are things that are going to happen. I think interest rates going up is going to maybe impact the real estate market 10 to 20%. It could be more, could be a little less. It's really inconsequential in the grand scheme of things, because I think at the end of the day, inflation is real, and real prices for hard assets, it's going to be gold, it's going to be real estate, it's going to be anything that's got a real physical component to it. Those values are going to go up. Energy costs are going to go up. Fuel, you're talking electricity, all these things, they're going to get more expensive. And with that, you're looking at, you want to make sure that you have your money inside of assets that are going to hedge you against that inflation. You could buy stocks, you could buy companies. I would avoid mutual funds, but you could buy stocks that have a component. If they're in sectors that you know are going to benefit from this, then that's fantastic. You could do that if that's what you understand and that's what you know and that's what you're comfortable with. Then by all means, go out and do it. But I think right now we have a period where we're going to see a bit of a tick back in the next, let's call it 6 to 24 months. We're probably going to have a point in time where interest rates that are rising are going to pull the values of things down, of assets down, like real estate. It's going to pull money out of circulation. That's just the nature of what happens by rising interest rates. It pulls money out of circulation and it depresses asset values. That's typically what happens, right? That is the concept of we rise interest rates. But here's the deal. At 8.5% inflation, a 5.2% mortgage rate, you're still negative in real terms, right? So if I could go get a mortgage for 5% and inflation is at 8.5%, that means the real terms of that mortgage are still negative 3.5% according to purchasing power on that money. Does that make sense? So when you look at that, that's what you have to be considering. And the real cost of money, as long as the cost of borrowing is less than inflation, then it's a negative number in real terms. And that's why I say that this idea of raising the federal funds rate to 1.5%, having mortgage rates are bumping up, but people have to see that is mortgage rates at 5% are still cheaper in real terms compared to the 8.5% because they're negative 3.5. Whereas a couple months ago, you could get maybe like, let's just call it 2 years ago at COVID, you could get a mortgage for 4.5%, but inflation was 2%, right? So that was real terms of a mortgage. The real cost of money was 2.5% higher than inflation. And so that's what matters. You have to understand what matters, what metrics to be looking at, because as long as, and the only risk here is wages and income. So as long as wages and income increase with inflation as well, I think we're looking at our government. They're not raising rates right now, or they won't raise rates because the economy, I think, is going to slow them down, and that's a concern. The jobs rate, the unemployment rate is going to slow them down. And that's what everybody wants to talk about. But the reality is, I think, what's more important and what's not talked about is the fact that they're in self-preservation mode. The government is just trying to survive. They know that by rising rates to the level that we need, we would effectively default on all of our debt as a nation. And so therefore, it's easier for them to inflate the currency away, right? Or to inflate the debt away, I should say, instead of going the other route and utilizing sound economic policy. I say this because we've been doing it for 100 years. We've lost over 95% of the purchasing power of our dollar in the past 115 years, 110 years, right? So since that's the case, we're going to continue to do that. And I think we're going to go through a period here over the next 4, 5, 6 years where that's going to be accelerated, where, because if you think about it this way, let me do the math here. At 8.5% inflation, and let's just say this is just the beginning of this, and we have this rate of inflation happening for a couple of years, with utilizing the rule of 72, at 8.5% inflation, that means every 8.5 years, the cost of everything is going to double. So effectively, if they keep this inflation going over the next 8.5 years, which is not outside of the realm of possibility, guys, just go back and look to the history of the 70s and 80s, and this happened. I mean, it literally happened. And if you look at those numbers, in 8.5 years, that $30 trillion becomes $15 trillion in today's purchasing power of money. Now, we're going to continue to add to that debt. There's all sorts of things that are going on that are wrong with that. But the bottom line is, I think that is the route that they're going to take. And so when we're looking to make our own personal financial decisions, we have to look at the people who are making these policies and understand why they're going to make the decisions that they're going to make. And all this talk about why the Fed needs to raise rates is just foolish. And this is why, one of the reasons why I'm really big on cash flow investing. This is one of the reasons I wrote this book. This is one of the reasons that that I think investing in real estate right now, even though everybody's talking about a real estate bust, it could happen. The real estate market could, I'm not going to say bust, but I think it is potentially due for a 10 to 20% pullback, depending on where you are in the country. But I think because inflation and because real borrowing costs in terms are negative right now, until that changes, until mortgage rates get higher than the inflation rate, I don't think we're going to see a real big tick back in real estate. It could happen, but even if it happens, I think if you buy the right properties that are cash flowing properly, that is the best place that you can put your money to be protected. So that's one of the reasons. If you haven't gotten this book already, I would really, really encourage you, go down in the description below, cashflowhackingbook.com. If you want to just type it into the URL, cashflowhackingbook.com. You can go to Amazon, look for Cashflow Hacking, and you can get that book for $19.99, or you can go to the link I just gave you, and you can get it there for $8.95. So all you have to do, we'll give it to you for free. $8.95 just covers the shipping and handling, and that is that. This is real right now. I'm going to be doing a lot of videos on this because what is going on in the world right now is I'm not going to say unprecedented, because we've been through something similar before. Paul Volcker did this, but the reason it is kind of unprecedented is because last time we went through this situation, last time we had inflation, the economy was in a different place. Our national debt was in a different place. Our unfunded liabilities was in a different place. And so the principles and how we can deal with it, the ammunition, the tools that we have to deal with the problem that we've created with inflation, is we don't have the same tools at our disposal that we had back in 1979, 1980. And so this is a real deal. And what you do over the next 12 months, a year to 5 years or so is going to have the biggest impact on what the rest of your financial life looks like. So if that makes sense, if you have any questions, comment in the comment section below. Reach out to us if you have any questions at all. Make sure you subscribe. hit the bell that we get notified. I'm going to be really putting a lot of focus on doing content around this because I think this is the stuff that everybody needs to know and needs to understand. Your financial strategy has to be in alignment with what's going on in the world today. A lot of the financial strategies and rules and concepts that people are following is outdated information that was designed to systematically work in a declining interest rate environment. So if that makes sense to you, make sure you follow, make sure you engage. I launch a video every single day. Check out my content. Go follow me on TikTok at Real Chris Kirkpatrick. And that's it. Have a blessed, inspirational day. We'll see you tomorrow. Take care.